Thanks for joining us for this episode of Notepad. This is, of course, the first fresh episode for the year. I'm back from the holidays, and of course, we're just trying to make sure that every show is done safely. And of course, we're making sure that the numbers do not continue to rise, not just for Malaysia, but for, of course, the region as well. In fact, there's a whole conversation on how the 2023 year is going to pan out for markets, especially for listed companies and perhaps economies in and around the region. So joining us via the phone right now, and of course video, is of course Anand Pathmakanthan, the regional equities head for Maybank Investment Banking Group. Anand, how have you been? And of course, Happy New Year to you.
Yes, Happy New Year to you too. I've been well. I'm glad we're starting off a new year because, as you know, last year was quite challenging for all asset classes, but especially equities everywhere.
Yeah, and of course, we saw, at least for the FBM KLCI, there was a jump or a shot in the arm when the announcement was made on the new Prime Minister, PMX, as we would call it. But of course, those highs have been tapered down. We're looking at 1480 last check, and of course, regionally, it's not much of a stimulus, so to speak. Most of the bourses in the region are more or less stabilizing. Do you feel that there could be some potential risks that lay ahead that might impact the growth and perhaps the interest of investors from coming into this region?
Yeah, actually, we're quite constructive on ASEAN's prospects for 2023. I think the reason why the market has been quite muted in the last 2 months, and especially for Malaysia, given the political changes, is the fact that investors, especially foreign investors, have been really distracted by what's happening in North Asia, especially the policy pivot in China to reopen, and completely ditch its zero COVID policies. So I think when that excitement sort of tapers off into the first quarter and investor attention or bandwidth continues to look at the other parts of the region, then I think ASEAN will get a fairer share of flows, and we will see markets start to perform better.
Okay, let's get in touch. Let's get in depth with the Maybank Investment Banking Group's 2023 market outlook, equities for the region first before we jump into Malaysia. What would be the key highlights, Anand, that you can share with us?
Yeah, so to give you some context, in 2022, pretty much all of the ASEAN markets outperformed their North Asian and developed market peers. We were viewed as a safe haven sort of region. Nonetheless, the markets did decline, just not by as much. I mean, Malaysia was down about 8-9%, but that compares to 20% plus in the US, 30% in China. This year, I think going into 2023, the outperformers from last year, like Indonesia and Singapore, which were actually up marginally in 2022, we think will continue to perform, but perhaps not as well as some of the cheaper markets in ASEAN. So when we step back and we look at valuations for ASEAN markets, 3 markets stand out as being substantially below their historical average in terms of PE multiples. And those 3 are the Philippines, Vietnam, and Malaysia. So I think these markets will play catch up this year. And for Malaysia in particular, we do see some solid underpinnings for why the market should perform better.
My conversations with AHAM Capital last week, as well as RHB Asset Management, both laid that COVID is one of the bigger risks involved, not just about the rising trades and consumer demand and foreign investment, many others, but COVID seems to be one of the bigger risks that people that tend to put on the table, but perhaps not focus too much weightage on it. Do you share these kind of views, at least from the house view of Maybank?
Yeah, the thing about COVID is, yes, it is a present risk, especially with China reopening so quickly. There could be some export of a COVID wave across the world. But I think the point that markets are making by being quite resilient in the face of this risk is that we've seen this before, and we're much better prepared to deal with a COVID wave this time around. And we know, like all waves, the wave will end. It may take a couple of months before it peaks and starts to decline. But beyond that, we're going to get back to business as normal. So I think markets are able to look beyond the short-term shocks of a COVID wave, take on board the fact that we're much better prepared, and look beyond that to how the world economy will look once China is fully reopened and these COVID fears are set aside. And arguably, the economy will look a lot better.
The geopolitical risks and political risk itself have been always on the topic of the day for this part of the world. Do you feel that that is being factored in by investors, both institutional as well as retail? Say, for instance, China versus Taiwan kind of conversation, or China, Hong Kong, or political risks happening in Indonesia because of the presidential election that's going to come soon. Malaysia having a new administration 2 months into the job. How do you view all these political machinations that's currently happening within the region?
Yeah, as far as the geopolitical, issues around China and its relationship with the US and Taiwan are concerned, ASEAN has actually been a net beneficiary of that, in the sense that we are seeing more and more investors and FDI looking for alternate production bases to China, so-called China plus one strategy. And we've seen FDI numbers across the region in ASEAN shoot up on the back of this sort of FDI flows. In Malaysia, 2021 was a record year for FDI. And 2022 is looking very, very good as well. We're still waiting for the final numbers to come in. So I think this will be a long-term structural thematic for ASEAN in terms of attracting FDI looking for a neutral production base as an alternative to China. So from that perspective, the geopolitics actually work quite well for ASEAN as far as China is concerned at this point.
And of course, sectorial outlook. What would be some of the sectors that would be of interest to you? Some of the sectors that you probably shy away even. And of course, some sectors that would see some sunrise technology impacting it and perhaps see some growth there as well.
Yeah, I think from an ASEAN perspective, it's really different strokes for different markets. I mean, for the bigger sort of domestic demand-driven markets like the Philippines and Indonesia, we kind of fall back on the sort of industries that did well in Malaysia 30 years ago. Property, construction, consumer-driven market industry sectors and stocks. That's because income growth is strong. There's a big domestic market, and gearing levels for consumers in these countries is extremely low compared to, say, Malaysia or Thailand or Singapore, which are much more mature economies. Then when we look at something like Vietnam, we're very happy to buy across the boards at these levels because Vietnam is showing very strong macro prospects. It's benefiting from the FDI inflows I mentioned before, but also domestically, we've had a lot of reforms that has made the economy much more robust. So they're growing at 8% a year GDP. And unlike Malaysia, we are supposed to grow at 8% for 2022 as well. Their 8% will last for many years to come because they're coming from a very low base. So, those three economies, you stick to basic industries, for also logistics and the banks, you should be okay. Most selective for Malaysia and Thailand. I think for Thailand, a lot of the tourism stocks and food and consumer-related stocks look interesting to us. Thailand is a big food exporter, and food prices have remained quite high. So I would expect Thai companies to benefit from that, as well as the tourism angle, obviously. For Malaysia, we like the banks. We like tech. You mentioned tech. So Malaysia and Singapore are where most of the tech stocks in the region are listed. So in Malaysia's case, stuff like Inari, Vitrox, Great Tech, Frontcan, we are very comfortable to hold given their very strong balance sheets. And the fact that they've come through this tech slump, at least so far, with their earnings relatively intact. And Singapore, attractive for two reasons. One is the yield perspective from their REITs. I think they have a very deep REITs market. So if you pick the right REITs, you can get a very dependable 6 to 7% sort of cash yield. And also their banks. So their banks are probably the most progressive in terms of adopting new technologies, things like AI, and also sort of going up the ESG curve. So the banks in Singapore would be interesting to us as well.
And I also want to look at some industries or sectors that we've been very well familiar with: oil and gas, energy sector, plantation, maybe. What is to become to these kind of sectors for these kind of markets for this year?
Yeah, so for oil and gas, or for the energy space as a whole, we remain quite positive. There's been years of underinvestment in oil and gas across the globe. So even though we've seen oil prices come off their peaks and gas prices as well, the supply-demand situation structurally remains quite in favor of prices remaining quite robust. And of course, if we have a worsening of geopolitical tensions around Russia, that would make the upside risk even more obvious. So, there's nowhere that this sort of positive view on energy comes out most as in Petronas's results. So if you've seen the Petronas's results, they're up almost 2x year on year. We think the national oil company will make about 100 billion ringgit in net profit this year, and that's really reflective of the very robust energy pricing out there still. Plantations, we are more subdued. I think we're past the peak for plantations, and we're seeing supply coming back. Foreign labor is also coming back to Malaysia, so the plantations in terms of supply of our CPO, we'll start to see a decent uptrend. So that's going to depress prices quite a bit. So our view on CPO prices is they'll probably close this year lower than what they closed last year. And finally, the 800-pound gorilla in the room when it comes to commodities demand is China. So a lot depends on how China performs over the next 12 months. If they can carry off the zero COVID policy pivot relatively seamlessly and the economy gets back on track very quickly, then China will be sucking in a lot of commodities, not just energy, but hard commodities as well, like aluminium, nickel, you name it. So that's going to be very good for the commodity space. So that would be good for stocks like, say, precious metal, the coal stocks in Indonesia as well as the nickel stocks in Indonesia.
I'm going to be asking you about ESG very shortly, but before that, staying on with commodities, but more importantly on nickel, for instance, Indonesia has imposed some export restrictions. Do you think that that is going to impact, say, for instance, investments inside nickel for the stocks in Indonesia, and what of the ASEAN market as well when it comes to commodities like nickel?
Yeah, I think Indonesia is doing it for a very sound reason. They don't want to be mired as a country that just digs stuff up and then exports it in raw form to other countries. That's a very low value added process. What they want to do is force companies to invest in processing capacity in Indonesia itself, where the real value add is, and that's going to create jobs and it's going to create economic growth. So the adjustment process is always a bit difficult because there are many companies which have existing contracts or don't want to take that investment risk in Indonesia. But we've seen companies, especially Asian companies from South Korea, from Japan, from China, step up to the plate and commit to capacity investments in Indonesia, especially in the EV battery supply chain, to take advantage of those commodities being within easy reach. So I think the policy is the right one, despite some modest disruptions in the near term. And I can see why they do it. So I would expect Indonesia to continue to attract FDI into the commodity space. And this will be much higher value add FDI as well. And that'll be good for the country.
Speaking about supply chain, not just about the commodities, but perhaps even the semiconductor industry and many other industries, that was supposed to be the highlight of 2022. Do you think that supply chain disruptions are going to be still the key risk to look at for 2023?
No, I think it'll, instead of being a headwind, I think it'll become more of a tailwind for earnings for tech companies this year, because a lot of the supply chain disruptions, logistics holdups, are really fading away very quickly into 2023. So that was a 2022 event. It had a very negative effect on revenues and margins of tech companies. So this year, the issue is more in terms of consumer demand for the end products, because all economies are going to slow this year. Because of rate hikes and because of inflation, and how big a demand that will have through the chain in terms of semiconductor components and related products. So there could be a volume impact in terms of how much business tech companies do. But in terms of margins, we think margins will actually improve because of all the supply chain bottlenecks that they were dealing with last year, which came with a lot of costs. All of those no longer being a factor this year. So positive and negative. So we put both together, we are still pretty constructive on tech.
Okay, one thing I like about reading Maybank Investment Group's analyst reports is because of the ESG rating. You have introduced this, I think, 2 years ago, if I'm not mistaken, please correct me if I'm wrong, but it has been made easy when it comes to understanding a particular sector or a particular company's efforts on ESG attainment. Do you feel that this kind of rating actually helps investors, both locally and abroad, in trying to understand better which companies do better, or is still left for wanting in terms of ESG practices?
Well, the first thing is investors are definitely demanding more and more ESG factor input into their investment.
No longer lip service, right?
No longer lip service. They set up dedicated ESG research teams, which we are now, connecting with to assist. And so, ESG is here to stay, and it's going to be a stronger and stronger factor when it comes to deciding which stocks to buy, and by extension, market performance or stock performance as well. And this trend, is not an isolated trend in terms of just our clients. The regulators are doing it, SE in terms of green financing. Bursa in terms of the voluntary carbon market, which was launched in December, in terms of their enhanced sustainability reporting requirements, which all listed companies will have to adhere to over the next 2 to 3 years. Everyone's pushing in the same direction. So you should have to get used to having ESG inputs as part of your investment consideration. Does it work? Well, yes. And over the last 2 years, as you pointed out, it's been a learning process for us. We introduced our own scoring just 6 months ago, actually, after we became comfortable enough with our knowledge base on sustainability matters and ESG. And when we back test the portfolio of stocks we came up with using that scoring, we found that they outperformed pretty much every benchmark, MSCI Malaysia, KLCI, and even our broader Malaysia coverage. So that appears to be a very positive correlation between good scoring ESG stocks and market outperformance.
Two other areas that I would like to explore to you before we head to the break. The first, of course, is interest rate hikes. We've seen the US Fed go up 400 bips and perhaps with no end in sight. Some other central banks are also in step raising it. Malaysia, for instance, is expected to raise even further. Do you feel that these increments of interest rates are actually doing the job, i.e. to stave off inflation, cool down some economies? Do you feel that it's doing its job? And perhaps will we see a terminal raise hike to some of these markets?
Okay, so there's good news on this front. In terms of interest rates, we are closer to the end of the hikes than the beginning. So I think even for the US, we're at 4.5% now. We think it will peak for the Fed funds rate at about 5.25% over the next couple of months. And then they will pause because the US economy is slowing and the data is coming in showing it is slowing. At the same time, inflation indicators are also softening. You already mentioned supply chain bottlenecks are no longer an issue. So logistics costs, commodities costs, etc., are all coming off. So you can see that inflation is on a downtrend. So I do not think the US Fed will over tighten. I think they will tighten a little bit more and then they will pause and they will see how things play out. And I expect the same for Malaysia. Malaysia, we expect another 25 basis points hike this month, taking the OPR to 3%. And I think after that, Bank Negara will pause because there's really, when you look at our own CPI numbers, 3% plus, it's not really screaming danger here. I think they can afford to pause and see how things play out.
Okay, and one final thing before we head to the break, which is of course currency. USD is very strong right now against key currencies. Safe haven currencies are not doing too well, including that of yen, for instance. Let alone minor currencies like ringgit or rupiah. Do you feel that these kind of items are going to be impacting how we view investing in 2023?
Yeah, I think for many foreign investors, especially FX movements in 2022 were quite a put off for investing in emerging markets because the dollar was king and everything else sort of diluted your US dollar returns if you did invest in those currencies. 2023, you think different story again, and this ties into interest rates in the US peaking and the US economy slowing. So this year we expect, especially in the second half, that a lot of the ASEAN or emerging market currencies will start to strengthen against the US dollar because the interest rate differential as the US stops raising will have narrowed. And with the US starting to slow down, people will start looking forward to rate cuts, perhaps at the end of the year or into 2024. And that's going to have a dampening effect on the US dollar. So, our own target for the ringgit this year versus the US dollar is to hit 4.2 by the end of the year. So we are looking at strengthening.
Okay, fantastic. We'll go for one short break. When we come back, we'll discuss a little bit more with Anand Pathmakanthan of Maybank. Thanks for staying on with us. I have with me on the line Anand Pathmakanthan, the regional equities head boss of Maybank Investment Banking Group. My God, you guys need to short form your job titles. Okay, Malaysia is a big deal for us for 2023. This is, of course, the year for recovery. The Prime Minister is in his first state visit to Indonesia, for instance. Yesterday, if I'm not mistaken, he made an announcement that up to 10 companies, 10 local Malaysian companies, are very much interested in trying to build Nusantara, for instance, the new capital for Indonesia. Some names were mentioned, including that of Bausat Heavy Industries and many more. Do you feel that this is a start of a good beginning for this administration in terms of trying to export Malaysian businesses to do work at least regionally, if not internationally?
Yeah, I think it's a very smart thing for the Prime Minister to visit Indonesia first among all of our ASEAN neighbors. It is the biggest boy in the block when it comes to ASEAN, and it's the one with the most promise in terms of long-term growth and the ability of Malaysian companies to make very profitable investments in that growing economy. So very very good idea to sort of cement our ties with Indonesia, especially given that there are these kind of projects like the new national capital that Malaysian companies could engage with. So I don't have a view on the new state or national capital for Indonesia and how viable or how profitable it could be for companies. But I will say this, that Malaysian companies already have substantial investments in Indonesia. The banks in particular, Maybank, CIMB, they all have sizable subsidiary operations in Indonesia. Axiata has sizable telco investments in Indonesia. And there are other companies which want to get into Indonesia. For example, IHH would love to have a healthcare footprint in neighboring Indonesia as well, which they don't have at the moment. So I think whatever strengthens our relationship with Indonesia does raise the potential for Malaysian companies to participate more meaningfully in that economy. And that's always going to be, in my books, a good thing in terms of corporate Malaysia.
Does that make a good story for Malaysian companies to attract more money coming into their capital, cheaper source of capital, even in terms of trying to grow their base outside of Malaysia? Does that make an appealing story for investors?
I guess you could use Malaysia as a base. It is very well located. It's right smack in the center of ASEAN, and obviously Indonesia is right next door. And we do have a cheaper source of capital. That's a good point. So you wanted to fund regional investments using cost of capital in Malaysia. It does potentially make your returns better. Yeah. But I don't know if, because there are currency issues as well, currency matching issues, and also local regulations as well in terms of how you fund investments that probably these corporates will have to navigate if they want to go that route. I think most would prefer to just partner perhaps with an Indonesian company. That would be the safest route to do it when you're entering a developing market. A well-established, reputable domestic company as your partner, and that will allow you to grow fastest. We see this having been done in China and India. I don't see why Indonesia would be any different.
I think in Malaysia, the local bourse is actually picking up in terms of interest. We saw a lot of retail investment, say, for instance, in 2020, 2021, but 2022 has been a little bit slow in terms of volume and the deals done. But of late, the trading day volumes have increased. The number of transactions have been increasing. Is this something of an optimistic view that you share, or do you think that this is just a flavor of the month kind of thing, but it's not sustainable throughout the year?
Yeah, actually in 2022, we did have a lot of IPOs, but they were just very, very small ones. They were raising 20, 30 million US dollars or ringgit. And it was not the big banks which were involved in these IPOs because they were quite small. It was actually the smaller investment banks and brokers who were pushing them, mostly ACE market listings, actually. So I think what's missing is really big IPOs. In 2023, the pipelines are there, but whether, these companies will press the button to IPO, really can't tell. It's really up to them. But what I can say is, we are meeting clients, obviously, over the last 2 weeks as we speak about or discuss our 2023 strategy. And there is a note of optimism that was lacking last year. And a lot of that has to do with the fact that, interest rates in the US appear to be close to peaking. But domestically as well, it's politics. Yeah, the fact that we got through GE15 without any major issues, and we now have a fairly solid unity government in place. So when you talk about risk premium for the market, which Malaysia has labored under for the last 2-3 years, perhaps we could see that risk premium decline this year, and that would allow the market to perform much better.
The last time you came on my show, I was asking you about GST, and you said there could be no possibility of the government, then government, to introduce GST. Now that the government has a solid majority, there's a budget coming up, presentation on the 24th of Feb. Do you think GST is going to be finally, at least slowly, being mulled in public by the government officials, or do you think that this is still off the table?
No, I think that's a good way of putting it. I think it'll be floated as a potential over the next 1 to 2 years. But I don't think there'll be any concrete timelines or steps taken to implement it in the near term. Our view as a house is, yes, subsidies need to be cut. Yes, new taxes like GST need to be introduced. Both of these will put our fiscal situation on a much more solid footing. But does the government, being a new government, does it have to do it this year? We don't think so. We think they have sufficient fiscal buffer, especially that provided by Petronas, which, as I mentioned before, is doing extremely well at this point in time, to tide them through this year, and they can tackle these issues next year when it's more, I guess, politically comfortable to deal with those kind of very controversial and disruptive issues.
It's hard, right? I mean, from 25 billion dividend to 50 billion, that was last year. This year, we don't know how many more billions going to be pumped into the government by Petronas coffers. This possibly can't go on forever. What do you think on this?
No, definitely not forever. I don't think we can hold off on fiscal reforms forever, but we can buy some time until the government is on a stronger footing to push through. Let's face it, it's going to be bitter medicine for the country. Yeah, you don't want to do it 3 months into your administration. You probably want to do it 15 months into your administration. Petronas actually is on a much firmer footing now financially than it was 2 years ago. 2 years ago, its cash reserves on net cash basis was about to dip below 50 billion. In the third quarter of 2022, given the high energy prices, it has recovered to almost 100 billion. And let's not forget, under the previous Pakatan Harapan government in 2019, Petronas also sold stakes in some of its listed subsidiaries on the KLCI or KLSE to raise money. And they can do that again, and that would raise about 14 billion without them losing control of these companies.
It's been a pleasure talking to you, Anand. Thanks again for joining us. That was Anand Pathmakanthan, the Regional Equities Head for Maybank Investment Banking Group. If you want to learn more about some of the research reports that they've done, do head on to Maybank's website and find out their 2023 market outlook for the region as well as for Malaysia. My name is Ibrahim Sani. Catch you in the next one.